Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update. The week is July the 22nd, 2019. And so the market still remains in Market State 1. Again, that is using the S&P 500. We've been in Market State 1 for now 23 trading days, and in that time we've put in 7 new market highs, which is to be expected because 85% of all new market highs occur in Market State 1. And keep in mind, the S&P 500 only measures, the largest 500 companies. So actually, small cap stocks, if we look at the Russell 2000, has been in a bullish market state for actually a very short amount of time. So, large caps have sort of led the market this year. And the market's pretty much at a peak right now, so the chances of, pullback are pretty high. Canterbury Volatility Index measures CVI 54. This continues to be low and decreasing. In fact, if we look at shorter term volatility as measured by a 10-day CVI, we will see that it is actually at CVI 37, which is sort of entering very extreme low, areas. So that's similar to the squeezing down of a spring. The further and further it goes down, the more likely you are to experience a spike of about 1.5% or more. If we couple that with the fact that the market's at a peak, the likelihood of this happening becomes a little bit higher. And so we've mentioned in prior weeks, the large cap equities have been one of the strongest performers this year. The S&P has been one of the leading indexes, and one way we can look at that is by comparing it to the Russell 3000. So the Russell 3000, sort of measures the broad market, both large caps, small caps, and mid caps. And an indicator we use to do that is called relative strength. So if we look at a chart of the Russell 3000 with its relative strength below, what that line does is compares how the Russell 3000 is performing compared to the S&P 500. And so when that line is sloping downward, the Russell 3000 is underperforming, and when it's sloping upward, it is outperforming. And we can see for actually most of this year, while the Russell 3000 has been increasing, it's underperforming the S&P, showing that large caps would really be carrying the Russell 3000's movement upward, whereas small caps and mid caps, while they might be in bullish market states, have really not experienced the same level of success. Then if we go to the advanced decline line, which measures market breadth, shows the number of stocks going up versus going down. So one thing we don't want to see is we don't want to see an increasing market and a decreasing advanced decline line. And so recently that line started to flatten out. So in other words, the S&P 500 put in a new high, while the advanced decline line actually put in, a similar high to, what it had last time. So it wasn't increasing. Now this is nothing to be alarmed about for the long term, but should this trend continue where the market's putting in new highs and the advanced decline line is putting in lower highs, that would be something to be concerned over the next, long-term horizon here. An extreme example of this would be back in 2000. So if we look at the market in 2000, it was being carried by some of the heavier weighted stocks and specifically the technology sector. So while the market's putting in higher highs, there's actually a significant amount of stocks falling off. So you see a decreasing advanced decline line, which would be an extreme negative divergence. And then moving on to the NASDAQ, one thing we want to see is the NASDAQ outperforming the S&P 500. It shows that investors are willing to take on a little bit, quote unquote, more risk. And we can see over recent history that, the relative strength of the NASDAQ compared to the S&P has been increasing, showing that the NASDAQ is, sort of leading the large caps for the S&P in that case. Again, these are all, individual indexes. What do you do with this information? And that's why the Canterbury Portfolio Thermostat's an adaptive portfolio strategy. It's treating every individual stock as its own market and taking the combination of securities to create an efficient portfolio. An efficient portfolio is one that can limit your risk in the portfolio to about 8 to 12%. And to sort of judge this, how do we determine if we have an efficient portfolio? Canterbury's developed portfolio metrics, and they are portfolio state, volatility, and benefit diversification. Those combine into an efficiency score. So Canterbury's current portfolio state is bullish. Its volatility is CVI 39 or 37, and its benefit diversification is 40%. And when you take all these things and combine them, that is an efficiency score of 100, which does meet the target for an efficient portfolio. Anything between 70 and 100 would be deemed to be efficient. And so making money in markets is really not about which index you choose to buy and hold. Buying, holding an index or buying, holding a fixed portfolio is really kind of a strategy based on luck and based on hope. And we know that investing, luck and hope are not good investment partners. And that's why you need an adaptive portfolio strategy, one that can adjust to the changing market environments and navigate through them, whether they are bull or they are bear. Thank you and have a great week.